next panel, which is going to be organized with my good friend Ludivine Wouters from Latitude 5. The panel is going to be geared at sustainable M&A to resource tomorrow. The different panelists include David Street, co-founder and CEO of Tembo Capital Management, Michael Ham, partner of Torys LLP, Kim Kalisvaart, portfolio manager of Oaks Point Capital, and Louise Pearce, global managing partner of Mining ERM. Please, if you can join me, I appreciate your presence. Thank you very much.
Hi everyone, nice to see you all today. I'm delighted to be joined by these amazing panelists to talk to you today about driving sustainable M&A to resource tomorrow. So as we all know, there's a lot of new stakes that we are positioning on as an industry, but also in connection with other actors in mineral value chains. And M&A happens to be an acid test for a lot of the statements, intentions, and actions that we take towards certain outcomes and objectives, whether they be ESG in terms of how we operate or how we also position on geostrategic stakes, including sourcing the minerals that are going to be needed to fuel the economy and the energy transition. So to discuss all this with us today, we have this amazing panel. I'm going to ask each and every one of them to introduce themselves quickly, and then we can dive into the conversation. Shall we start with Pim and work down?
Yeah. Hello, everyone. My name is Pim. I work for Hawke. We're a UK-based mining investment fund. So we make investments as a kind of cornerstone investment into pre-production companies typically, and like to stay with them and invest with them all the way through to development, construction, and then ultimately production.
Awesome. And I'm Louise Pearce. I work for ERM. I'm the global head of mining. ERM is the world's leading sustainability consultancy. And so really about ESG expertise in this context.
Hi, my name is David Street. I'm one of the co-founders of Tembo Capital. We manage 3 mining private equity funds. We're based in the UK, and we invest globally in junior, mid-tier mining companies around the world. We try and partner with them, help them to grow into significant producers of different types of metals.
And I'm Mike Am, co-head of M&A at Torys LLP. We are a law firm based in Canada with international reach. We do transactions across the world and all around the mining sector. I'm very pleased to be with you today.
Thanks, Mike. Actually, let's start with you, because the first topic we wanted to touch on is how ESG is being repositioned as an imperative in M&A, across the mineral space. And I think one of the points you were making is that you're seeing this really as an aspect of every part of your M&A practice today.
I think that's exactly right, Ludivine. I think the key word you used was imperative. And we're seeing ESG considerations have really increasing impact on all areas of M&A transactions that we work on. Really throughout the whole process, and clients are looking at the reputational issues, the commercial related issues, and just the practical execution. And it comes to every corporate stakeholder has an interest in the ESG story of an M&A transaction, whether it's shareholders who have to approve the deal, whether it is financiers who are providing the capital, employees who are doing the integration, and regulators increasingly as companies wind up having a lot of new liabilities for offshore operations, new liabilities for supply chain issues, for human rights violations. It's becoming more and more important. And one barometer of how, at least I've seen things change in the last number of years compared to earlier in my career is you look at the press releases and the announcements for any significant public M&A transaction, and you'll hardly find one that does not justify the rationale for the deal in ESG terms and indicate the ESG benefits. And it's become de rigueur to have, for every significant transaction, a whole ESG narrative. And that is a really interesting paradigm shift that has really changed how we see things play out. And I think we have seen it not just in mining, but in all sectors where we do M&A work. But mining is special in this regard because mining has often outsized ESG impacts. And when we look at the history and the challenges that mining has, this is a great opportunity for mining to show some leadership, and that's going to attract more capital and more M&A activity.
Yeah. And Pim, you were mentioning that the scope of review that you employ as an investor has widened significantly over the last few years. Does this echo what Mike has been looking at from his perspective?
Yeah, it's been always very important for us, and we're investors that are very slow into coming into an investment. We take months of due diligence covering all areas, including ESG, and we want to have a high conviction that those assets that we back tick all the boxes, and in particularly on the ESG side, and that's because we're passionate about it, but also we want to be on the long-term journey, and we can't vote with our feet if something bad happens. So we want to understand all the skeletons in the closet and the strategies around them for where the asset is now, as well as I explained, we look to invest typically in pre-production assets. So we recognize that there's an entire pathway as the company goes through its development, and we need to understand that there's a strategy in place today for how the ESG challenges will shape up as the company goes through its development, construction, commissioning, and production. So with that in mind, ESG is a very big point of focus for our due diligence, because the geology is something we can kind of wrap our brains around, and it's a expanding target, or so we hope. But ESG is almost this moving target that can have an outside, and I'd like to think of it as almost binomial impact on an investment. And it's not that, it's kind of half good, half bad. No, it's either making for a great investment, or it literally turns it into a donut. So that it's kind of black and white in that sense. Hence the emphasis, and the only real way of doing it is to go there yourself and talk to the local communities, the regulators, and all the stakeholders as part of getting the full picture.
Yeah.
I just say I agree with everything that Pim just said, and it's always been a big part of our due diligence as well. And we're probably similar style of investors to Hawke's point. We invest in companies. We own 10, 20, 30% of quite small companies usually. We help them to grow. They then get listed, or they continue their journey, and we have quite a lot of input into those companies to make sure that they're operating in a responsible way along that journey. But we are very focused when we get into these investments about what the exit might be for us as an investor. And typically, we invest in a small company, it goes through that journey. Maybe it gets into production, it grows as a company. Maybe it lists, we can sell shares, it becomes a big company. That's one way we might exit the investment ultimately 5-10 years in. But the other obvious one is through an M&A transaction where a bigger company comes along, buys the asset. And those big companies really are actually a sort of form of asset manager in themselves. They have a portfolio of assets. They rank those assets on all sorts of ESG criteria these days. It's changed markedly over the last 10 years. They're interested in greenhouse gas emissions on each site. And all of those assets are ranked, and they will move their portfolio in a more favourable ESG in terms of metrics. They'll move it over time. And so when we look at these assets, we want to do the right thing. We want to have the right relationships with communities, etc. We want to be responsible citizens, but we have in mind who might we sell this mine to down the road, and the buyers have become increasingly particular about the assets they want to acquire.
Let me rebound on that to the two of you. So how do you now look at management teams and or engage with them following your investment with this as a whole element of the delivery of value. Has it changed your views on that or your positions? I don't know, Pim?
Yeah, it's definitely an active talking point, just like we want to get an update on geology, on budget and any fundraising considerations. We want to get an update on a very periodic basis, and it could be as much as weekly, on anything related to ESG, to ensuring that they're on track. We insist on certain protocols being put in place if they aren't, as part of our initial investment, and that is just to set the stage. Those then need to evolve as the company grows and develops. So it's a journey. Sometimes we need to get them to be at the right starting point for the journey. And then from then on, it's a continuous growth. It never stops. And it's part of every interaction we have with management and or every site visit we have and so on and so forth. It's part of the investment story. It never stops.
Yeah.
And I think that part of that is the assessment of management at the outset and whether they actually have the real values around what they're doing and how serious they're taking the topic. We looked at a transaction earlier this year, maybe late last year, and we made a financing offer to a company, and one of the conditions was that they employed a full-time environmental person, which we felt their team was sort of lacking in that respect. That transaction didn't happen in the end, but it's an example of how seriously we do take it.
So the integration of the skills and the values is a whole point of due diligence and assessment. And Louise, I wanted to come to you because I know one of our points of discussion is the fact that this actually plays out slightly differently in the critical mineral space because of the geostrategic, stakes and the drive for increased discovery and production. Touching wood.
Yeah, no, absolutely. I think that's changing the whole dynamic. So you've got, all of a sudden, you've got this push by a lot of major existing mining companies and a whole bunch of new entrants. So the OEMs or right down to the technology companies coming into the space, trying to secure supply. At the same time, governments are securing supply. We see the challenges, well, Russia was clearly, but also the challenges in China. China has a lot of the world's supply of all the battery minerals, if you will. And so you're seeing, Australia, Canada, the US, Europe, UK all have critical mineral strategies. And so it's opening up a different dynamic. So we probably, at ERM, we work cross-sector, but we get as many calls from an automotive company or a battery, company, private equity into the space than whereas before it was just mining. It was very, very insular, our world. And I think as mining people, our world is so open now. And it gives us opportunity as well as challenge. And I think the ESG side is so critical. And on the ESG side, just to pile onto what Pim and Dave said, is we've been tracking projects since 2008 on major capital projects in both the energy and the mining space. And way more than half of them are delayed. And they're almost always delayed because of some environmental issue that turned into a social issue. And so it's just, and it could be small scale, it could be local, or it could be international. And it's just amazing. There's so much money that's lost. I think the other, watch for folks in the critical minerals space, I think it's easy for us to sit back and say, well, we're going to provide the critical minerals for the low carbon energy transition. But if you actually don't walk the talk and talk the talk, it's like, well, don't do that at the expense of creating a whole bunch more carbon into the atmosphere. It has to be all neat, or I think the consumer demands are coming through. Yeah, it's very interesting. It's a hard bar. The bar is shifting. The number of standards out there, it's a hard bar to meet. Yeah.
And of course, in the context of M&A, we'd like to think about the transaction, but then there's the growth story behind it. So, beyond the statements of intent, you were mentioning you need to walk the talk. So where do you think that bar is headed? Where do you think are the key points that we need to be baking into projects today to be able to achieve that level over the next 3 to 5 years to get them funded and operational?
Yeah, it's really interesting because, as Pim said, we can get our heads around the resource geology. We have a lot of resource geologists that work for us. I'm in the room. But so it's kind of finite. And then if you're a junior and you're exploring, it's like, why am I thinking about closure now? Why am I thinking about alternative land use now? And the answer is because you have to. And that equally gives you opportunity. So you don't have to be the mining company hero that creates secondary, tertiary economies, that builds this whole thing, and then you leave that really negative legacy that the mining that still hangs over our head, I think, as a sector. I think what you have to get ESG right from the onset, and it's just equally as important. And I hear a lot of people saying, I don't even know if I have resource yet. It's like, yeah, you still need to be thinking about what life after the mine. You still need to be thinking about what that social value you're going to create. And it's just absolutely part of that license to operate now at the very, very early stage.
Yeah. And I mean, Mike, how does this translate into the areas of due diligence that you do? Because that is actually also the foundation for the future growth story. So how do you address these different points through the due diligence process?
That's for sure a critical point. This is a neat panel to talk about that on, because in M&A transactions, of course, the lawyers are doing diligence broadly, but we're focusing more and more on specific ESG matters. And it's not just the lawyers working alone. It is Louise, it's you, all of us working together to try and present something to David and Pim before they make an investment, and it becomes a much more integrated process. And just to cover a couple of specific things that we look for, when we looking at a target, we're looking at its overall governance and ESG framework and approach. How does it look at ESG? Does it have a plan? What is that plan? Is that plan actually implemented? And if you start at the top, that's going to give you a lot of clues. Do they have their house in order, or is it chaotic? And that's going to inform the type of diligence that we do. And we look at what is their compliance history. Have they had problems with local communities, with environmental, with permitting? And having the problem is not the biggest issue, because we've identified it. The biggest issue is, how have they dealt with it? What's their culture? Have they embraced it? Have they owned it? Have they ameliorated it? Or have they ignored it? And when you get into the ignoring it or not effectively dealing, that's where you get a lot of red flags. And a lot of what we also do in the space is we look at indigenous and community matters, and that is increasingly important. And we increasingly see clients, whether it is private equity, whether they are listed mining companies, whether it's royalty and streaming companies, looking as part of the transaction to make specific ESG commitments. So they are doing their diligence up front. What are the local community indigenous issues? How are they being addressed? And in fact, how can the acquirer help that? And one last point I want to mention, just because we've been talking about OEMs and non-miners coming into the system, this has created more interest on supply chain and sourcing and human rights diligence, because ultimately, at the end of the day, if you've got an OEM who's a major technology company who's in auto sector, otherwise in EV, the last thing they need is to have bought into a project, have it operating, and finding, in fact, there's all these human rights problems, because that's going to go directly to their customer base and potentially imperil not only their investment, but also their brand and their reputation. So a lot of focus on that.
So we're very far from due diligence as trying to create some certainty in a very uncertain context. We're actually embracing a lot of the uncertainty here. And actually, yeah, both...
Actually, if I may jump in, I think there's an element here that's changed. You know, the answer, and very articulately laid out by Mike, you know, that answer and those statements haven't changed over the last, well, at least since we've been in business. And I'd like to think, you know, sometime before. But what has changed now is that people start to look at the next step down and start to look, okay, it's not only my product and what I'm producing here, but what happens in the next step afterwards. And it's in part led by geopolitical circumstances that are playing out very actively today in the form of rebalancing away from China and seeing what's going on with Russia, that people now start to say, okay, hold on, this might be a great project and it ticks all the boxes and all the local communities and everything else on board, and it's based in Australia, but what happens next? Oh, it goes to China, pause to think. And that never was the case in the past. And I think that is a real shift in thinking and in approach that we're seeing as part of the ESG umbrella that we're having very actively happen now as compared to 3 or more years ago. And how it plays out, there's a lot of things in the air. There's a lot of initiatives, government-led initiatives. It sounds like a vote-winning statement, but we need to see what happens next, because there's an awful lot behind that. And just to say, oh, we're going to onshore it is one thing, but that's like the UK saying we're going to build loads more houses. When once NIMBYism hits, then there's a clash somewhere, and you never know where that comes out. And the same is what we're going to see happen here when in continental Europe, here in the UK and in America. People really want to onshore it and then start to appreciate the actual consequences of it, and the processes involved and the chemicals involved and all the rest of it. I'm not quite sure where it's going to balance out, but that's a complete unique dynamic that we didn't see until very recently.
And it kind of speaks to your point about the insular mentality, which is now having to be confronted with all of this new pressure and new stakes. So that also changes the dynamics in terms of your assessment.
Totally. I mean, you could have the most perfect project in a local context, and if you don't have the whole value chain, the supply chain figured out, it's going to come back. Because, I mean, as Michael said, if you come and you've got this project where if you've got this this new investor or new entrant investor, and they care way more about that reputational risk than anything else. Billions to a technology company that can raise billions in a day, whereas we might take a few days to do that in the mining sector. It can take the whole house of cards down, and so they're really, really focused on that. And I think it's exactly what Pim said. You've got to. It's not just what it is. It's not just what you say. There's a lot of pulling out now. There's a lot of accusations of greenwashing, ESG washing. Is it real? Is it measurable? Is it tangible? So you've got to get 2 or 3 layers down in terms of how you manage these possibilities. And it goes way beyond what's actually in your control to downstream and to customers and where the power is coming from. And if you're an iron ore manufacturer, where does it go? And what's that power? And what's your contribution to climate change? Because it's immense.
So we're talking about fairly new risk pricing mechanisms. Yeah. And this is happening with everybody in the world coming out with a standard. Most of them using the same words to say slightly different things. So how do you feel about that emergence of a colossal diversity of standards? Are there already elements where you can see, okay, we can use enough of the commonality to really define some tools and benchmarks? Or is it too chaotic and you just do your own analysis based on your own, criteria?
Yeah, I think there's 2 things at play there. So in the standards, we track about 47 different standards. So from a copper mark to an IRMA. And then you look at how in-depth the standards go, ICMM criteria, ISO, whoever it is. So IRMA is probably the most stringent, and we've worked a lot across the world with a lot of companies, and I don't think anyone's scored more than 50% compliance so far in 2 years of implementation, so it's a really tough one. But what we're seeing, I was in Washington 4 weeks ago, and the government was thinking about adopting IRMA as an SEC regulation. I was like, whoa. That's a lot. So there's a need, I think, for the industry to look at equivalency, to agree, to get these things combined, and what is that minimum standard that we'll abide by? Because otherwise, the maximum standards going. And so if you're, when we're out in California and they say, oh, we want you to comply to ARMA, you saw a lot of automotive companies also out of Germany saying, because we think it's the best one. But it's actually a very hard bar to meet. And it's very onerous on the sites. And then you got sites who are really trying to do good end up just trying to prove that they meet the standard versus actually doing the good that they do. And so I think there's a need for consolidation there. And there's a need for some connection to the ratings agencies as well, because the ratings agency, they all have different formula, different algorithms, and it disconnects. So one would think if you had really good water policies, if you had really good carbon reduction net zero goals, your ratings would go up. But it doesn't align that way. And then when you translate that into share price or share value, there's about 3 different disconnects along the way, and it really should all add up. If you perform better, you should have a higher share price or a higher, acquisition price. It makes a difference, but it's not quite there. It's very complicated, and it needs a lot of consolidation. Yeah, probably more consolidation than the gold industry needs these days. But yeah.
And I mean, David and Pim, how does this ultimately factor in your decision making, both in terms of the initial funding decision and then the continued engagement?
I think it's always been very important for us, and always been a significant part of our investment sort of process and papers for since we've been in business the last decade or so. And I'm going back earlier in my career. I worked as a banker at Rothschilds, and we way back in the 90s we were looking at World Bank guidelines, equator principles, etc. So a lot of these topics are sort of have been around for a long time. The thing that we are more focused on now as a specific point is particularly we're looking at a lot of projects in North America, and we generally end up hiring a consultant to inform us on the permitting process. How long is it going to be? How binary an outcome is there? Just what sort of risk are we taking with that process, and what needs to be done by the company? And some of these processes are very long, and we're quite long-term investors, but that's a really key focus for us, I think, particularly in North America at the moment.
And Pim, how do you position on all of these standards?
Yeah, we
Do you have
definitely
your own secret sauce?
We definitely engage local expertise to help us. I don't think there is a one-size-fits-all, so it's local, and when I say local, it's not just the country, but if we use the US, it would be that particular state or even county. And similarly in Australia, we look at a state or district, because these issues are so local and have these local quirks and peculiarities that you need to avail yourself of local expertise. And that isn't, like I said before, it's a journey. It's an ongoing process. We applaud all the standards that are out there. As the portfolio currently stands, I'm still in the luxury position to define the ESG-related matters as individual to the company and assess which ones are important for that particular portfolio company in its circumstances. And luckily we can do that because of the size of our portfolio. I think the mining industry needs to come together behind one standard very, very rapidly. Otherwise we'll have to adopt something that is simply not suited for purpose and becomes a race to the lowest common denominator, which makes absolutely no sense. Because for us to just measure CO2, and the spirit is correct, but it misses an awful lot of nuances that are relevant to the mining space. And if we want to live up to it in the spirit of it, then we should come up with a standard in the spirit of it. And then also find a way to come up with some kind of an auditing mechanism, because as soon as there's a number, someone's gonna, just like in accounting, you take a number, call it EPS or whatever, and someone's gonna quickly find a way to manipulate the number, and then the IFRS is finding shuts that door, and someone finds another loophole, and so on and so forth. And the same I expect what we'll see here, and you'll get, give me an incentive, and I'll tell you the outcome. So tell me what you think the incentive is, and people will adjust their mechanism and start counting whatever they need to count in terms of animals or emissions, and tweak their behavior. So make sure that you have an auditor or someone ahead of that to make sure that we keep evolving that. But we're cutting it fine in terms of time to come up with our own consolidated answer. But it's very easy for me to say that sitting here. I don't have a preferred provider or outcome, but I do see the need for that to happen. But until that's the case, we'll continue with our process and define the key parameters within our investments, which are unique, even if they're in the same state and in the same commodity and in the same stage. They're still unique to that particular company, that set of individuals, and that project.
I do feel strongly on this point because, just as an example, going downstream a bit, we act for in the EV space, a global bus and coach manufacturer whose entire raison d'etre is, number one, to put people in public transit, to take vehicles off the road, and to replace gasoline, diesel, and hybrid engines with EVs and with hydrogen fuel cells. And they've got a very advanced ESG function. And they came to us and said, well, we're looking at various different standards. And it was remarkable how poorly they scored.
Yeah.
And their whole reason is really ESG. And it turned out there's nothing wrong with what they were doing in their business. They just weren't measuring things the right way for those standards. And we were just sort of left, is this really the right outcome? How can this be? And it just speaks to your point about we need a single set of rules that is sensible to apply and really gets us to the right substantive outcome rather than a box-ticking exercise.
And that's to get the generalist investors in there. Yeah, specialists will do their own work and understand that, and I expect here in the room enough people will have a good understanding. But if we want as an industry to attract specialist investors, non-specialist investors, so generalist investors, and or the likes of automotive companies who have behind them generalist investors or non-mining specific investors, in order to facilitate that path, we need to come up with something pronto.
Yeah. And I think it goes beyond the standards too. I mean, because if you think about the Task Force on Carbon-related financial disclosure, and now what's coming up on the nature-based financial disclosure, it's almost like carbon becomes money, and nature and what you're doing for the animals or whatever becomes some sort of currency. And so there's a need to treat it like you would your regular accounting. So carbon accounting is not something that you ask a site for once a year and you report on. It's this continuum that goes across and down the supply chain. And it matters. So it matters that local, in the same state, it matters where that power supply comes from. It matters where how you can influence how that power supply comes from. Because when you're looking at, most of the world now has a net zero carbon target or is thinking about one. And in order to get to net zero, it's the whole thing that gets to net zero. It's the whole mining and metals ecosystem. And so what's your role in that? How do you contribute to that? And where you go? And it's very, very complex. And so when you think about a standard, you just got to be careful that it's not just about your site. It's about where you sit in the broader value chain of the world as well. So that's why it's complex.
And what that entails is that very early stage, we need to start factoring this into the decision making. We're talking about exploration, as you said. We're way before resources, and yet we're thinking about all of this because we link to those stakes. We did have a question that we were going to pose to you all via Slido, so I don't know if that can be popped up there. And it touches on this. So basically, you were mentioning the incentive for most mining exploration projects. The incentive is being funded to be developed if they find something and or being bought if they find something. So the last question I wanted to put to everybody in the room and to the panel is, do we really see a change in exploration decision making that's linked to increasing importance of sustainability parameters in the M&A practice? Because if it's really changing how we are thinking about sustainability throughout exploration, then it means that we're gearing for the future. If it's still a lot of talk and not a lot of walk, then we risk having projects that may not meet those standards, and we need those for the future. So, I mean, if I come back to you and ask you, are you seeing a change in how exploration is making its decisions with a view to that?
Definitely, just look at the amount of money being spent in lithium. That will be a case in point. So in terms of where the money is attracted to, then that's an example. Maybe beyond strict exploration, on the development side, yeah, we see a lot of changes. And I think a lot of the companies that are at the pre-production phase are finding themselves at a highly exciting time, because rather than having to re-engineer their fleet, they can select an electric fleet from the start. And an electric fleet on an underground mine means less emissions, means no need or need for smaller ventilation, and so on and so forth. So we're seeing live examples now of people adopting ESG-related mechanisms that change simple things like mine design. I think it's a highly exciting way that impacts the industry that's playing out live.
David, are you also seeing this? I mean, we mentioned permitting a few times. That is one of the key areas of friction between all of these different interests. Okay, obviously we have 93% coming out saying that management teams are indeed required to understand. So
Yeah,
I'm not sure we're being optimistic or projecting our own requirements, but yeah, that's a staggering amount.
I think it's certainly improved over the last number of years, and I think Pim made some good points about the mine design, feasibility studies. A number of our portfolio companies are looking at, power supply options at a very, very early stage. PEA type stage. So I think that things have improved. I'm wondering whether 93% is a bit optimistic personally, but I think it's good that people have recognised that.
And on permitting, are you seeing changes in terms of both the timeline, how it affects the positioning of projects?
I came across a rather unique example the other day, where there was a company who'd done a little bit of exploration and got a sniff of an ore body, but it wasn't developed yet to what I'd say is a critical mass needed to get the finance society excited. And with that, I mean, potential equity investors like ourselves, and then further down the line, debt investors and others. Yet they seem to rush to getting a study out and progressing the project, which seems to be a little bit like putting the cart in front of the horse. So when I inquired about them, it turned out that they had recognized that permitting was one of their critical pathway items, and what they decided is to go with, my words, a half-baked cake and get the ball rolling in order to start what they perceive to be the longest process ahead of drilling out a robust resource. So I think that's a particular example whereby I'm sure the intention is right, but now we're kind of moving to the flip side of what it should be. This should be well worked out for everyone's sake, including those at the permitting office and including the local communities who will have a say into that in the consultation process. So it's a delicate balance, and in this particular case we decided not to invest because I couldn't quite see what this project was going to be, and to my mind fast tracking or starting the clock early rather on the permitting didn't have a true benefit. So I recognize that permitting is one of the longer lead items, but I think the way they had approached it was something that I couldn't support. I wanted to see first what the resource could really do before you start rushing to applying for a permit.
It's a really interesting dilemma because, as you know, in the U.S. it can take 10 years to permit a mine, and And then you look at, so when you look at the new entrant investors, you know, it's not quite about that sort of block model value of the resource. There's always more life there if you explore more. But it's, so expediting that permitting in these jurisdictions like Canada, like Australia, like the US, where it's 5 to 10 years to get something off the ground. Because you pile that with the onshoring, friendshoring that's needed today to secure critical minerals, for example, it really, you know, you have to get out ahead of that. And I think the mining company also has to have a lot of influence, because 10 years to permit a mine is not good enough. And then you allow, you know, different, it's in the US, it's very litigious. So you have thousands and thousands and thousands of objectors. It takes years and years and years, and that's not going to get us to where we need to be in 2030. Because, yeah, it's going to change.
One key aspect of what we're talking about here in permitting is the indigenous relationship and the community relationship. And it is important to start that relationship early.
Yeah.
You can't be exploring for 5 years, show up to try and make a development decision and say to an indigenous group, I'd like to start my negotiation now, and our relationship now, because their answer will be, well, where have you been for the last 5 years? You need to lay that groundwork, build that relationship if you're going to have a reasonable expectation of longer-term success.
Yeah, and the best projects would actively involve them, right? They would have people, you know, depending on the skill level, either provide catering or assist on drilling services or otherwise. You have to find ways to engage them early and show them, even if you're running a relatively small program like an exploration program, to show the economic benefits of that on itself. Buy local, and so on and so forth. So yeah, you can start that from the day that you get the permit granted, for sure.
Yeah, there's a complex balance to build trust with
Takes time.
people you need to engage very early, but also not to destroy trust by starting to make statements about permitting way before you're able to back them. We have run out of time, and I don't think we left any space for questions. Are we good on questions, or are we done?
Yeah, unfortunately, we have to sort of move on, but I think all the panelists will actually be around to go and take questions if you want to go and find them afterwards in the exhibition area. Can we please give a warm round of applause for a fantastic panel? Thank you very much.